Imagine a company that generates over $10 billion in revenue in a single year.
Right. Which is just a massive number.
Yeah, a massive number. And they do it by building tens of thousands of houses across, I think it's 37 different metropolitan areas.
Yep, 37.
But here is the catch.
Yeah.
It's a big one. They absolutely despise owning the dirt those houses sit on.
They really do. It's completely counterintuitive.
It really is. So today, we've got the ultimate cheat code to figure out exactly how they pull that off. We're digging into NVR Inc.'s Form 10K for the fiscal year, ended December 31st, 2025.
Oh, this is going to be fun.
Yeah, our mission today is to, uncover this brilliant, highly unconventional strategy that makes NVR one of the largest home builders in the U.S.
And we're going to use those 2025 financial results to basically run a real-time stress test on the American housing market.
Exactly. Because if you're listening right now, you don't just want a surface-level summary, right? You want to know the real mechanisms hidden inside these dense financial documents.
Without drowning in all the accounting jargon.
Right. You want to know how the machine actually works.
And it's a fascinating machine to dissect, mostly because it completely flips the traditional American real estate script on its head.
How so?
Well, the old adage has always been, buy land, hold land, build on land. Real estate is supposed to be this ultimate tangible asset.
Right. They literally say they aren't making any more of it.
Exactly. But NVR operates entirely differently, and if you look around the U.S., you've probably seen their work without even realizing it's them.
Oh, for sure. Because they don't build under the name NVR, do they?
No, they don't. They build under the brand Ryan Homes, which targets, your first-time and first-time move-up buyers.
Okay, Ryan Homes, I've definitely seen those.
Yeah, they're everywhere. And then they have NV Homes and Heartland Homes, which are geared more toward the luxury side, higher-end move-up buyers.
Got it. But to really understand how they navigated the incredibly turbulent waters of 2025, we have to start with their fundamental DNA.
The land strategy.
Yeah, the land strategy. You mentioned earlier that they hate owning dirt. And logically, in the home building industry, acquiring raw land is where the massive financial risk is, right?
It is the single biggest risk, absolutely.
Because normally, a builder buys a huge plot of undeveloped land, and then they spend millions just navigating local zoning boards.
Oh, and running sewer lines, laying down electrical grids, paving the roads.
And that process can take years.
It often takes years. And for all those years, your capital is just trapped in the dirt. It's completely exposed to whatever the broader economy decides to do.
Okay, let's unpack this. Because this is exactly where NVR diverges from the rest of the industry, right?
It is. Instead of trapping their capital in raw land, NVR uses something called a lot purchase agreement.
An LPA.
Right, an LPA.
Yeah.
So here's how it works. NVR basically waits for independent third-party developers to do all of that heavy lifting.
So they let someone else fight the zoning boards.
Exactly. They wait until the developer has finished the lots, meaning the roads are paved, utilities are hooked up, and the lot is literally ready for a foundation to be poured.
Okay, and then what? NVR steps in and buys it.
Not exactly. They step in and pay a deposit, usually up to 10% of the total purchase price.
Just a deposit.
Just a deposit.
Yeah.
And that buys them the exclusive right to buy those finished lots at a fixed, predetermined price at a later date.
Okay, so they aren't actually buying the land. They're just buying the right to be the only one who can buy the land.
Yes. It is essentially an options contract.
An options contract on residential real estate.
That is precisely what it is.
To put that in perspective for you listening, it's kind of like a massive version of just-in-time manufacturing, right?
Right.
Like what Toyota does with car parts.
Oh, that's a really good analogy.
Right, because Toyota doesn't warehouse millions of steering wheels. The steering wheel arrives at the factory the exact hour the car is ready for it.
Yes, and NVR is doing that with physical earth.
That's wild.
They don't warehouse the land. They only finalize the purchase of the dirt at the exact moment they are ready to build a house for a buyer who has, already signed a contract.
So the buyer's already locked in before NVR even owns the ground the house will sit on.
Exactly. What's fascinating here is the legal firewall this creates around NVR's balance sheet.
How does that work?
Well, the 10K states very explicitly that if NVR chooses to walk away from one of these lot purchase agreements, their sole legal obligation.
Their maximum loss.
Right. Their absolute maximum economic loss is just that 10% deposit amount.
Wow. So the creditors who loaned money to those third-party developers can't come after NVR if things go south.
Not at all. They can't touch NVR's general credit. The developers hold all the debt, the developers hold the completion risk, NVR just holds the option.
Okay, let me stop you there and play devil's advocate for a second.
Sure, go for it.
Because I'm trying to put myself in the shoes of that third-party developer. Why on earth would I take on 100% of the massive financial risk of buying raw land, laying the sewers, and paving the roads just to let NVR hold a measly 10% option?
It sounds lopsided, right?
Yeah. I mean, if I'm taking all the risk, why wouldn't I just build the houses myself and keep all the profit? What is the symbiotic relationship here?
You really have to look at it from the developer side of the ledger.
Yeah.
See, developers are essentially project managers for dirt.
Okay.
They are very, very good at navigating zoning laws and moving earth, but they do not have massive consumer marketing departments.
Or sales teams.
Right, or sales teams. But more importantly, developers need to secure massive construction loans from banks to pay for all that heavy machinery and infrastructure.
And banks are usually, terrified of lending money for speculative dirt.
Yes, they are terrified of it. But if that developer walks into the bank and says, hey, I have a signed contract from NVR.
One of the biggest builders in the country.
Yeah. Exactly. I have a contract guaranteeing they will buy these lots at a fixed price the moment I finish paving the roads.
Oh, I see. Suddenly that bank loan gets approved.
Immediately. NVR brings the sheer volume of buyers. They are a guaranteed blue-chip pipeline, so the developer gets bank financing because NVR's name is on the contract, and NVR gets to keep their balance sheet clean.
That is brilliant. It allows NVR to operate an asset-light model in a historically, asset-heavy industry.
Perfectly said.
But I want to put that protective asset-light model to the test here. Because if we look at the reality check of their 2025 numbers, it was undeniably a tough year.
It was a very tough year for the whole industry.
Yeah, we're looking at a struggling macro environment. Total revenues for 2025 were $10.3 billion.
Which is actually down 2% from 2024.
Right. And net income dropped 20%.
Down to $1.34 billion.
And the actual number of homes they settled, meaning homes fully completed and closed, with the buyer that dropped 4% to 21,915 units.
Yeah, the broader context in the filing is vital to understanding those drops, though.
What does NVR blame it on?
They explicitly cite a trifecta of macroeconomic headwinds that hit them really hard in the second half of 2025. First, ongoing affordability issues for consumers.
Driven by interest rates, mostly.
Exactly. Mortgages were just too expensive. Second, unusually high home inventory levels in certain markets.
So too much competition.
Right. They specifically note rising resale and new home inventory in their Southeast segment. And third, just general economic volatility that dragged down overall consumer confidence.
People get nervous. They stop buying big things.
Exactly. They stop buying houses.
I hear that, but I have to push back a little on the invincibility of this LPA strategy.
Okay, let's hear it.
If this lot purchase agreement model is so brilliant and it shifts all this massive land risk away from NVR, why did their gross profit margin still take such a noticeable hit?
The margin drop.
Yeah, it dropped from 23.7% in 2024 down to 21.2% in 2025. That is a real squeeze on profitability. If they were so risk-averse, why did they suffer that margin compression?
If we connect this to the bigger picture, the LPA model is designed to protect NVR against massive land devaluation and trapped capital.
Right.
What it cannot protect them against is the reality of the consumer's wallet. When affordability issues peak and buyers vanish, NVR still has to sell houses to keep their operational machine running.
So they have to compromise somewhere.
Exactly. The 10K notes that in the second half of 2025, they had to actively reposition many of their communities.
And reposition is just corporate speak for adjusting pricing and offering heavy financial incentives to buyers, right?
Precisely. You are fighting tooth and nail for a shrinking pool of buyers, which means you have to give up some of your own profit margin to close the sale.
But wait, dig into that with me for a second.
Sure.
Because if they don't own the land, and they don't have a massive mortgage on that dirt ticking away every month, why do they care if a house takes a few extra months to sell?
That's a good question.
Why drop prices and compress your own margins if you aren't sweating a debt clock?
Because of velocity and cash flow. NVR makes money on the turn.
The turn?
Yeah, the speed at which they can convert a contract into a completed home and a closed mortgage. A stalled community might not cost them a monthly land mortgage, but it ties up their deposit capital.
Oh, right.
It strands their construction crews, and it stops their mortgage subsidiary from generating origination fees. Velocity is their lifeblood.
Got it. Speed is everything.
Furthermore, you can actually see that consumer distress clearly reflected in their cancellation rates.
I saw that. In 2023, their cancellation rate was 13%.
Yep.
In 2024, it crept up to 14%. But in 2025, it jumped to 17%.
Which is significant.
Yeah, that's more than 1 in 6 people who signed a contract to buy a house having to back out. Whether they couldn't get mortgage financing, or maybe they lost a job, or they just couldn't sell their existing home to make the move.
Exactly. So the asset-light model doesn't make them totally immune to a bad economy. Well, here's where it gets really interesting, though.
Okay.
Because when you look closely at one specific line item in this 10K, you realize the LPA model is actually working exactly as intended, even if it looks like a massive loss on paper.
You're talking about the contract land deposit impairments, aren't you?
Yes, I'm talking about the impairment.
This might be the most revealing number in the entire 100-page document.
Right. Okay, so in 2024, NVR recorded about $7.2 million in contract land deposit impairments. Basically, they forfeited $7.2 million in deposits by walking away from land contracts.
Normal cost of doing business?
Right. But in 2025, that number absolutely skyrocketed to $75.9 million. Now, I'm trying to wrap my head around celebrating a $75 million loss. If I lost that much in my portfolio, I'd panic.
Most people would panic. But you have to fundamentally reframe what that number represents in the context of their strategy.
How so?
NVR evaluates their entire portfolio of controlled lots every single quarter. They analyze it community by community, very granular.
Very. They look at current market prices, their own construction costs, and something called sales absorption levels.
Just to clarify for the listener, sales absorption level basically means the pace at which homes are selling in a specific neighborhood over a specific period of time.
Yes, exactly.
Like, are we selling 4 houses a month here or 0?
Right. It's the speed of the market. So if NVR runs the math for a specific community and the absorption level drops and the required profit margins just aren't there anymore, they do not hold out hope.
They don't just sit there and wait for the market to bounce back.
No, they don't wait for miraculous market recovery. They purposefully default on the contract. They willingly forfeit that 10% deposit, and they walk away entirely.
Wow. This raises an important question then. How much money did NVR actually save by walking away from that land?
Let's do the math. If that $75.9 million represents just their 10% deposit.
Then they avoided buying over $750 million worth of finished lots in a declining market.
Yes. By taking a $75.9 million hit, they avoided trapping $750 million in bad real estate.
That is staggering.
And that's just the land cost. They also avoided pouring hundreds of millions of dollars of labor and lumber into building houses on those lots that nobody wanted to buy.
So taking that $75 million impairment is actually a highly calculated strategic retreat.
Exactly. It is the ultimate proof of the genius of the LPA model. They paid $75 million for the privilege of walking away from a billion-dollar disaster.
So it's not a loss, it's an insurance payout. That completely changes how you read the balance sheet.
It really does.
Okay, so we see how they save a ton of cash by aggressively cutting their losses on the front end with the land.
Right.
But avoiding a loss isn't the same as making a profit. An empty lot doesn't generate revenue. How are they extracting maximum value from the buyers who actually do stick around and close on a house?
This brings us to their back end, which is a highly integrated closed-loop system.
Operated through their wholly owned subsidiary, right?
Yep. NVR Mortgage Finance, Inc., or NVRM. See, they don't just build the house, they finance it.
I saw the numbers on this. In 2025, NVRM closed over $6 billion in loans.
A huge number.
And the capture rate is what really stood out to me. They captured 86% of their home building customers.
Which is incredible.
It really is.
Yeah.
That means almost 9 out of every 10 people who buy an NVR home use NVR to get their mortgage.
And that capture rate generates a massive secondary stream of revenue. They aren't just making a profit margin on the physical construction, they are monetizing the origination fees.
And the loan processing.
And even the title services through separate subsidiaries. But true to their intensely risk-averse nature, they do not hold on to those 30-year mortgages.
Right. The 10K states that they sell all the mortgage loans they originate into the secondary market. typically within 30 days of closing.
Yep, get it off the books quickly.
And they mostly do it on a servicing released basis. I want to pause there because that's a pretty heavy finance term. For the listener, what exactly does servicing released basis mean in plain English?
Sure. So when you get a mortgage, there are basically two parts to it. There's the actual debt itself, the money you borrowed,
Okay.
and then there's the administrative act of collecting the monthly payments, managing the escrow, dealing with customer service. That's the servicing.
Got it.
When NVR sells a loan on a servicing release basis, it means they are selling the debt and they are selling the right to collect those monthly payments. They are completely washing their hands of the customer's financial future.
So they originate the loan to the strict standards set by, like, Fannie Mae, Freddie Mac, or the VA.
Right.
They collect their origination fees up front,
Mhm.
and then they pass 100% of the long-term credit risk off to an institutional investor.
Exactly. They squeeze every drop of immediate cash out of the sales funnel without holding the bag for the next 30 years.
It is all about cash flow generation without capital detention.
They strip the profit out of the transaction and immediately reload their balance sheet, which naturally leads to the next question.
What do they do with all the cash?
Right. What does NVR do with all the cash they generate from this incredibly efficient machine?
They buy themselves.
They do.
Even in a down year like 2025, where we established that revenues and net income dropped, they still generated over $1.1 billion in net cash from operating activities.
A huge cash pile.
And they took that cash, tapped into some reserves, and repurchased 243,082 shares of their own common stock for over $1.8 billion.
That is a staggering display of confidence. I mean, think about it. They are looking at a tough housing market, shrinking profit margins, rising cancellations.
They are saying the absolute best investment we can make right now is in our own model.
Exactly.
But why is that so effective for them? Like, why buy back stock instead of hoarding cash or buying more options?
Because it artificially boosts something called their return on equity. See, when you buy back your own stock, you shrink the total number of shares that exist in the world.
Right.
So even if the company's overall net income drops, the earnings per share can actually go up because the profit is being divided among fewer shares.
Yeah.
And because they use the asset-light land model, they don't need to hoard billions of dollars to buy raw dirt. They can freely return that capital to their shareholders.
That makes perfect sense. But I suppose that incredible efficiency creates a very different kind of vulnerability, right?
What do you mean?
Well, if you don't own physical land and your entire operational lifeblood is this frictionless digital pipeline of mortgage data, title transfers, and rapid cash flow, a disruption to that digital pipeline would be catastrophic.
Oh, absolutely. And the 10K shows they are acutely aware of that. They aren't ignoring the future.
Yeah, as they digitize more of this closed-loop system, they are actively flagging new, severe operational risks.
The cybersecurity stuff.
Yeah, I caught that in their cybersecurity disclosures. They specifically singled out the rapid evolution and increased adoption of artificial intelligence.
Which is something you don't expect a home builder to be terrified of.
Right. But they noted that AI is heightening their cybersecurity risks by making cyber attacks significantly more sophisticated and much more difficult to detect, contain, and mitigate.
It's a stark reminder that even a brick-and-mortar industry, literally a company that pours concrete and frames lumber, is having to play aggressive defense in the digital age.
Because if their mortgage pipeline gets hacked and frozen, their velocity drops to zero.
And the whole machine stalls. It proves that long-term survival isn't just about clever accounting. A company has to maintain absolute discipline across every vector: financial risk, operational speed, and digital security.
So what does this all mean for you listening? If we step back and look at the entirety of this 10K, NVR is fundamentally a highly disciplined machine. It's built to survive the brutal, cyclical boom and bust nature of real estate.
And they do it by systematically refusing to hold the heaviest bags.
Exactly. They force the developers to hold the raw land risk. They force the secondary market to hold the 30-year mortgage risk. And they focus purely on the velocity of building and selling.
They willingly trade away the potential upside of land appreciation. Like, they won't get rich just because a plot of dirt doubles in value,
Right.
but they gain the absolute downside protection of the lot purchase agreement. And in a rocky year like 2025, that downside protection is exactly what allows them to generate enough free cash flow to buy back $1.8 billion of their own stock.
While their competitors are struggling just to keep the lights on.
Exactly.
Well, thank you for joining us on this deep dive into NVR's 2025 financials. If there is one crucial takeaway today, it's that true business resilience isn't just about making the sale.
No, it's not.
It is about recognizing the exact moment the math turns against you and having the discipline to strategically walk away.
I love that. And I'll leave you all with a final thought to mull over.
Let's hear it.
If NVR can successfully use this asset-light, options-based model to completely dominate an industry as physically heavy, slow, and capital-intensive as home building, what other traditional asset-heavy industries are ripe for this exact kind of disruption?
That's a great question.
Right. Could you build an asset-light car manufacturer that only buys the factory space the day a car is ordered?
Wow.
What about an asset-light airline? The framework for shifting massive capital risk is right here in these pages.
That is a fascinating thought. We hope you take this framework of risk shifting and apply to whatever industry you find yourself navigating. Keep learning, keep questioning, and we'll catch you on the next deep dive.